Rising crude oil prices often trigger headlines and knee-jerk assumptions. If oil goes up, every oil company wins. But for Petron, a leading refiner and fuel marketer, the story is far more complex. Petron isn't in the business of drilling and extracting crude. Instead, its core economics hinge on refining margins, known as crack spreads, the difference between the price of refined products and the cost of crude oil. A spike in crude prices only benefits Petron if product prices and crack spreads rise even faster. When that doesn't happen, higher crude can mean tighter margins, strained capital, and pressured demand. Recent numbers tell the story. In the first 9 months of 2025, Petron's net income rose 37% to 9.67 billion pesos, even though refining cracks softened and product prices dropped. How? Higher domestic sales, lower costs, and increased refinery productivity drove profits. Margins, not headline oil prices, were the critical factor. Crude rallies don't just affect profit. Each peso increase in barrel value inflates working capital, the money tied up in inventory and receivables. As of September 2025, Petron carried enormous stocks: 77.6 billion pesos in inventory, 70.7 billion pesos in receivables, and 53.8 billion pesos owed to suppliers. When crude jumps, funding these assets puts pressure on short-term loans and raises financing costs. Demand also matters. Higher pump prices can dampen consumption. In 2025, Petron's consolidated volume slipped 3% despite retail gains. This push and pull shows that market share can rise even as total volumes soften when prices bite consumers. Foreign exchange is another risk. With $1.17 billion in net foreign currency liabilities, each 1 peso move in the dollar can swing Petron's pre-tax income by over $1 billion pesos. Currency volatility, often paired with oil shocks, can create further headwinds. Petron's policy is to hedge, not speculate, using financial tools to smooth out volatility, dampening both risk and potential windfalls. So what should investors focus on during an oil spike? Watch margin movements, shifts in working capital, financing sensitivity, and currency exposures. Profits depend not on crude prices alone, but on execution and cost discipline. For Petron, it's the quality of the margin, how fast the market buys what it refines, that decides whether higher oil is friend or foe.